are some of the worst mistakes people make with their investments? Well, here to talk with me about this is Dana Anspach from Sensible Money. Dana, welcome.
Hi, Bob.
So I'm eager to learn about the mistakes that people make with their investments and perhaps even some of the catastrophic mistakes they make.
Yeah, we could look at different investing mistakes in categories. Mistakes where you lose a little bit of money and you're kind of like, oh, why did I do that? And then catastrophic mistakes that wipe you out. Like literally, you are starting from zero. And I could also break the mistakes into mistakes I've seen clients make and mistakes I've made myself. So I thought where we'd start, is some of the things I've seen clients do, and particularly two catastrophic mistakes I saw that just, it really breaks my heart. The first was, she was a widow with four children and remarried and had a large portfolio, over $4 million. And, as she remarried, they were of a particular religious affiliation. And they had been a client I had worked with for a few years. And they decided they wanted to go to a firm that did everything, estate planning, tax, and investments, and was of the same religious affiliation as they were. And so they did, and sent a very nice letter, you've been wonderful, but here's what we're doing. And about 2 years later, I heard back from them, and they wanted to come in and ask me to see what happened to their money. So they brought in a stack of documents. And I literally remember turning like white as a ghost as I was reading through it. So they had signed two promissory notes and lent the money to basically a private real estate deal, but with, no official private placement paperwork, just you sign a promissory note and go, here's $2 million and here's my other $2 million. And the note was paying 12%. And so they got a few interest checks and then nothing more. And, they would reach out and the advisor would tell them, well, the project was encountering these difficulties or that difficulties. And after getting put off for long enough is when they came back and asked me to look through the paperwork. I sent them to an attorney and, unfortunately, that money was gone. So it was their entire life savings, all 4 million. That is, in my career of now over 25 years, the worst, what I would call catastrophic mistake that I've seen. And it could have been avoided.
Yeah.
That's the challenge. When I think about, those private investments, us as financial advisors, we have a set of rules we would need to follow when investing your money. And so if somebody wanted to put a portion of their money in a private investment, we might say, well, the maximum you should do is 10%. I could get sued if I put 100% of a client's money in an investment like that. But as a client, you can do whatever you want, right? You can decide to take that kind of risk. So, it was very opaque. They didn't understand. They trusted the person. I think they allowed their emotions in terms of that, a religious affiliation, kind of say, oh, of course we trust them. And they signed over $4 million and it was all gone.
Yeah. So when you think about the principles that were violated here, I guess a couple come to mind for me. That this notion of the prudent man rule is at play. The principles of diversification are at play, and perhaps the principles of investing only in what you know and doing the required due diligence before you invest is required here.
Yeah, I think it's easy with friends or people that we trust to not go through a formal due diligence process and think, oh, well, I believe them. I mean, I've made this mistake myself, which I'll talk about. Of course, they've done all of the work. And so, this will turn out fine. And I don't think there's anything wrong. We all like to take a flyer, I'll call it, on some of our money. But if you do that with all of your money, not understanding that risk return trade-off. So you can earn 12% on this money or lose it all. Like that's not a good risk return trade-off. You might say, okay, well, if I stayed in a diversified portfolio over time, I'd likely earn 6 to 7%. So if I think there's this investment that's going to pay double that, 12, how much of my portfolio should I allocate to that? Well, not 100%.
Right.
Definitely not 100%. So those are some of the rules of thumb or prudent way of looking at that you could follow to avoid making that kind of catastrophic mistake, or take it out of the catastrophic category into the, oh, I lost some money, but it's not going to wipe me out. I'll recover.
Right. I'm also reminded of Warren Buffett when he approaches investing. He also says, "I'll invest in something where I can afford to lose 50% of my investment, but no more." And of course, it seems like they violated that rule here too.
Yeah, can you afford to lose 100% of this investment? And, in their case, the answer was no. Like, that's it. You're starting from scratch.
Yeah.
Yeah.
Any other client examples?
Yeah, there is. The second catastrophic situation I've seen. This was back in 2005, 2006. So I, had a business partner at the time, before I had started Sensible Money, and he had taken a look at this private real estate investment. It was a company in town in Scottsdale and Phoenix called Mortgages Limited. And it actually, when it all went bad, it made the cover of the Wall Street Journal. And so, but its company had been in business for 45 years. It had never lost a dollar of client money. So we did all of our due diligence, as many other sophisticated investors did. And we had pooled client money, went to our more sophisticated clients and said, there's this opportunity to invest in this, and here's the return it's paid historically. But we did a prudent amount of their portfolio, no more than generally 10% of a client's portfolio. And then when the real estate market crashed in 2007, Mortgages Limited ended up filing bankruptcy. All of the private loans in the portfolio went under. It is still in recovery mode. So, what's that, over a decade later, right? They're still working on recovering funds. Like I said, it made the cover of the Wall Street Journal. Well, none of the clients that we worked with got wiped out except one. One looked at this investment and said, "This is so good, I want to put all my money in it. I don't like the stock market. I'm nervous about the stock market." And we said, "We won't do that. Like, I won't. It's not prudent," right? Literally. And I have to follow a set of rules as an advisor. I won't do it. So he pulled all his money from us and said, "Well, I really have enjoyed working with you, but I want to do this." And he went directly to that company and put 100% of his money. He was of retirement age, somewhere between 60 and 65, about ready to retire. And of course, when this went under, it wiped out. Now, people have recovered maybe 50 to 60% of their money, but it's taken over a decade to get that portion back. So you're about ready to retire, and your entire portfolio, is suddenly frozen. It did trickle back out, but that is what I call another catastrophic loss.
What's the principle violated there, or the lesson to be learned there?
I think, similar is to what we discussed before, is following a diversification plan. So how much of your portfolio would it be prudent to put in an investment like this that is less liquid? We can say anything we want about the stock market, but it's very liquid. And, we know it's very volatile also, but if you don't have to liquidate the market when it's down, and you have patience, and historically the market has always recovered, versus some of these what I call opaque investments. They have risks that it's very difficult to identify. And when the whole real estate market crashed, and this whole company that had been in business for 45 years went under, in hindsight there was fraud in play. There was some things that should have been known, but there was a lot of sophisticated people who did their due diligence and no one spotted it. And so it was an opaque investment, not publicly traded. And so it can be very difficult to spot these types of risks or situations that could be going on. But even if you can't spot them, if you simply followed the rule and said, "Well, I wouldn't put more than 5 or 10% of my money in something that's not publicly traded and very transparent," then you would have avoided that type of catastrophic risk altogether.
Yeah. I mentioned before this notion of not investing in things that you don't understand. As a general rule, would you recommend that folks, to avoid mistakes, avoid investing in things that aren't publicly regulated by an SEC, for instance, as opposed to these opaque investments that are private in nature?
I think you really, I wouldn't necessarily say I'd avoid them altogether. For the average person, I would avoid them altogether. I have invested in opaque investments myself. I've seen people make money in private placement type investments, but it can be very difficult, like I said, to see what's going on in that black box. And so I really think, it's either something that you do as a strategy where you're spreading your money out across a lot of different types of these investments versus I'm going to put, all my money in one. Of the 25 years I've been in business, I've now seen two of these private and placement investments really pay off. One was, I believe, is now Loan Depot, but I think it was called iMortgages when it came out. And I had a client put like $25,000 in it, which was a very prudent amount relative to their portfolio size. And I think, ended up getting almost $500,000 out of it. So that was, excellent, but he did it right. Right? He was in the real estate mortgage industry. He understood that industry. He understood the risks. So he only put $25,000 in. Yeah. And in those situations, I think it can be okay to put some money in. You just have to follow a prudent set of rules about how you do it.
Right. Any other mistakes that clients or you have made that are worth noting?
Well, definitely I'll get into some that I made. The other one I want to talk about that I've seen a client do, and luckily this client, put about $80,000 into a currency trading program and was, about ready to retire, actually had just retired. And I remember because they called me up and said, Dana, I won't need to take any of that money out of the portfolio. We had his main portfolio set up to start monthly distributions. And I was like, what? What's going on? Well, I found this currency trading investment and it's paying me, I think it was $4,000 or $5,000 a month on an $80,000 investment. I remember my heart, just my stomach, that sinking feeling, because I know that's not possible. Yeah. It is not possible for an investment to pay out those kinds of returns. And yet he didn't know that wasn't possible. And within a few months, it was discovered to be a Ponzi scheme. And so he did get a few checks, but essentially that $80,000 was gone. But again, it was a very prudent amount that he did, so it didn't wipe out his portfolio. And so he was okay, still, quite disappointed to lose $80,000 right when he retired. So when I think about that, same situation as Bernie Madoff many years ago, is people not understanding what is possible. There are limits in investing. There are, patterns that are realistic and patterns that aren't realistic. And if you believe that risk-free returns are possible, you can get sucked into some of those scams more easily versus if you have a set of what is actually realistic. And if something looks too good to be true, it is violating some fundamental principles here, and I should probably stay away.
Yeah. Other mistakes?
Well, we'll talk about some of mine.
Okay.
So, it was a relatively small mistake in hindsight, but I was in my mid-30s, and generally, I do with my money what I tell our clients to do. I use diversified portfolio of index funds. I follow a very prudent process, but like anyone, sometimes you like to go, I just think I want to put some money in this. And so I had a friend who had done what I thought was a lot of due diligence on a penny stock. And, it was going to, if I remember correctly, it was going to, create some kind of a centralized database for law enforcement versus it was all dispersed, right? No states' databases talk to each other. So it was some kind of technology around that. And I thought, well, this sounds like a great idea. And he's done all his research. And so I put in, I believe it was about $11,000, which for me at the time was, too much. That's the honest truth. It was too much of my portfolio. And of course, that penny stock ended up, I don't think it went to zero, but maybe I got $1,000 out, 5 years later when I finally said, oh, this isn't actually going anywhere. So, what did I do? Well, I didn't follow my own rules. you know, I mean, it's okay to put some money in a penny stock. I probably should have put in $1,000.
Yeah.
That would have been a prudent amount if I really thought, you know what, I think this has some potential. For me at the time, it was too much.
Yeah. As you're mentioning this, I'm thinking of, I just had a conversation with the author of a book about Warren Buffett, where Warren Buffett says that his most famous mistake was actually buying Berkshire Hathaway, the name of the company, and the mistake was that he overpaid for it. He let his emotions get the better of him, et cetera, and that he keeps the name Berkshire Hathaway to remind him of his one big investment mistake, and so even investors of his nature are prone to making mistakes, but they learn their lessons, perhaps.
We're all prone to making mistakes. And we talk about that, here with our planners around watching out for our own biases. So we talk about behavioral biases contributing to investing mistakes, things like overconfidence or recency bias. And so we have to be highly aware as advisors that we can be subject to these biases and make mistakes as easily as anyone else. Now, for me, there's things I've done with my own money that I would never recommend a client do. My penny stock is one example. There's two other, what I call big mistakes that I made. One wasn't the underlying investment. So you and I did a video, 2 years ago now on cryptocurrency. And in that video, I love the technology. I'm very excited about what it can do. I still am. And I talked about investing 1% of your portfolio, right?
Yeah.
1%, very prudent amount. Now, I invested more than 1%, and the actual cryptocurrency I bought has done just fine. It's actually significantly more than what I paid for it. But what I underestimated was the custodial relationship, and I held my funds at BlockFi, which is a custodian that filed bankruptcy. So my funds are now tied up in bankruptcy. I don't know if or when I will get them back or how much I will get back. So it's interesting because the underlying investment I made has done just fine. But I can't access it, and I don't know what I'll get back because I missed a key risk. I was aware of the risk. In my mind, minimized that risk. I thought, well, that situation's not really going to happen. And, that custodian's not going to run into those kinds of troubles, but it did. And so my funds got tied up. And so that's what I call, sometimes we just miss a key risk, or in our head, we don't realize what would be the magnitude of that risk be. I see this with clients that have too much money in a single stock and they simply won't part with it. Many, many years ago, I remember a woman at a CPA firm I worked with, and she had over $10 million in Intel stock, would not part with it. And it's not understanding, and that stock did go down by well over 50%. I believe her 10 million went to about 3 million. And, it's not understanding the magnitude of that risk. Like, what is it going to do for your life if that stock goes up another, let's say it doubles again, versus what's that going to do to your life if the stock goes down 80%? Yeah. So you really have to weigh that out. So it's not just in the investments that you put money in, but it's also in what you don't get out of, right? In her case, it was concentrated stock. And if she had exited out of it, she would have, had an incredible lifestyle. And as it ended up being, she's still going to be okay with 3 million, but that's not nearly the lifestyle that $10 million portfolio would have provided for her.
Yeah, about 2/3 less than it would have been. Yeah.
Yeah.
Any other mistakes that you've made that are worth noting, or?
Yeah, there's one more significant investment mistake. So, this was a few years ago. I'm a part of a group of women who do real estate investing, and I really joined to learn more about investing outside of what is, our normal realm. We use index funds and very publicly traded, diversified, transparent portfolios. This group does a lot of, private real estate investing, whether it be rental properties or hard money lending. And one of the girls and her husband girls, women, let me use the right word, grown women. So one of them and her husband had bought some property and had this fabulous idea, and they had experience doing this, to build an RV park. It was on a lake, and you would come up and have these kind of condos where you would dock your RV and have this lakefront place. And of course, the RV business is booming. 12,000 people a day turning 65. So that business is, I just talked to a client the other day, a 2-year wait list for the RV they want.
Wow.
So everything checked off. They had the experience, the partners, the pro forma, looking at the financial returns. And I thought, yeah, I would like to invest with her. And so I did, it was a private placement within my Roth IRA. You have to open a self-directed IRA. And what happened is their contracting partner got COVID and died. Now, his contributions to the project was the contracting expertise. So now they didn't have a contractor. In order to find one, they needed to pay one, versus before, I believe that person was going to contribute their human capital. And they didn't have life insurance on that key person. And so they had to sell the project. Now, they did a fabulous job, actually, of marketing it, and we ended up getting about 66 cents back on the dollar. But still, that was one of those, it was an opaque investment. The actual project was solid, which is why it was saleable in the end. People had the right expertise. They'd done it before. I would have had to have a very thorough due diligence process to go down and start asking questions like, do you have key man insurance on your contractor? That would have been the question that would have been asked. And maybe if someone had asked it, they would have gotten the insurance. You never know. But I didn't ask. And so, it checked all the boxes. But again, I missed a key risk.
Yeah. So it goes back to also this notion of you can do all the due diligence, but if you don't know the right questions to ask either, it becomes problematic too, right? You don't know what you don't know.
You don't know what you don't know. And I didn't think to ask. And when I think about all of these things, I kind of kick myself in the butt, because the majority of my money, all my retirement money, is invested exactly the way we invest clients' money. And that has done just fine. And so I sit there and I go, Dana, you don't have a great track record with doing things outside of this. Why do you even do it? And my nature as an entrepreneur is a risk taker. And so understanding that nature more and more can help me say, you know what, that may be your nature, but just put your money the same way your client, and don't do these things that sound so shiny. They sound so shiny, right? That we get emotionally sucked in. It's like, oh yeah, this is going to do this and it's going to be so cool. And we miss those key risks, or we violate, policies around what is a prudent amount to put in.
Yeah. So as you're talking, Dana, I'm reminded of some of the work I do at the Street was a few years ago with Jim Cramer, and he's often criticized for his show Mad Money. But when you talk to Jim Cramer about how he invests money and how he thinks people should invest money, he says for your retirement funds, I don't want you investing the way I'm talking about on Mad Money. Mad Money is money you can afford to lose, not money that you should be setting aside to pay for expenses in retirement. And so, when I think about what we're talking about here is if you have a portion of your portfolio for Mad Money, for money you can afford to lose, and it represents a small portion of your portfolio, well, maybe you can afford to take those risks. But if you're not viewing it that way, maybe you shouldn't take those risks.
I agree 100%. I'd love to see those kind of disclaimers, not only on his show, but on, other types of advice that are kind of spouting off these more risky strategies. It's interesting because we have a lot of clients who will keep the bulk of their portfolio, with us, but will keep they call it their play account. And sometimes we'll even tag it, their play account. And they will tell us, that's going to keep me out of the rest of my money. We've had several people say that to us. If I can just have this little pot over here that I can, play around with the stock, or, write covered calls or whatever it is that they like to do, that will keep me from risking the bulk of my assets. And I think that can be a great strategy for people like me who tend to, want to take risks. It's great, I can take those risks with this little pot. If I lose it all, I'm done. But the rest of the money needs to be in something that's far more appropriately invested with more predictable outcomes over long periods of time.
Yeah. And the other thing that our discussion, at least for me, yields is this notion around a better understanding of risk. People like Anna Marie Lusardi from George Washington or Olivia Mitchell from University of Pennsylvania, they talk about how little people know about risk and probabilities and the importance that that plays in terms of becoming a better investor. I'm curious for your thoughts.
I love that. I was talking with a client's son who just graduated from high school. And so they wanted to gift him a small amount of money and have him start to learn how to invest. So one of the things we went through was risk return trade-offs. And I went through what I call my risk scale 1 to 5. So a level 1 risk, I tell people, what's the most important question you can ask? Can I lose all my money? Now, if I would have asked that about the private and placement and investment into the RV park I did, the answer is, yeah, I can. Crypto, yeah, I can lose all my money. And I was aware of that in these cases. So I understood the risk. When I think about the clients who invested, their entire portfolio on a promissory note, did they ask that question? Can I lose all my money? If they had asked and said, well, yeah, I could, would that have caused them pause to say, I probably shouldn't put all my money in this? And same with the client that put all their money in the mortgages limited, private lending strategy instead of just 10%. If he had asked himself, can I lose all my money doing this? And would that have kind of been that wake up call to say, oh, wait a second. So I think that's really important. And when the answer is no, we call that a risk level 1, right? Can I lose all my money? No, risk level 1. On the opposite side of the spectrum, we have people say, can I lose all my money is 1. Can I actually, that's on the 5 spectrum. I'm going backwards. Can I lose any money is, a risk level 1. So you want to say, can I lose any money? Well, in most investments, you can lose some money, right? If you sell at the wrong time. So when you're talking about a risk level 1, that would be, can I lose any money in a savings account, a bank savings account under FDIC insurance limits, right? That would be what I call a risk level 1. So now I've got my scale going the right direction.
Yeah.
And then up to that 5 is, can I lose all my money? Well, I asked this young man, think about Tesla stock. Could you lose all your money? He thought about it and he's like, well, yeah, theoretically I could. And I said, exactly. So that's a risk level 5, right? That's, and so the question is, do you want any of your money at that level of risk? And if we want to shift that from a risk level 5 down to a 4, where your portfolio could certainly go up and down in value, like we could invest in an index fund, very diversified, that owns 2,000 publicly traded stocks, and I could be talking to you in 3 months and it could be down 30%. It's happened in the past. But if you're willing to hold it over long periods of time, it's unlikely that it's going to permanently lose money, right? It's historically much more likely that it's going to recover its value. And so I was able to explain that difference between that risk level 5 and then scaling back to a risk level 4. And what does that really look like? So yeah, those could be just 2 key questions that you could ask. Can I lose all my money? Can I lose any money?